Never trade without risk to reward. That's the fastest way to blow your trading account. Now, in this video, I'm going to break down risk to reward, why it's the single most important principle in Forex, how to calculate it, how to use it to grow even the smallest accounts without gambling. By the end, you will know how to set proper stop losses, avoid blowing accounts, and actually turn trading into a numbers game instead of an emotional roller coaster. So let's get into it. What is risk to reward? So first, what is risk to reward? Now, in simple terms, risk is simply how much you're willing to lose on a trade. Reward is how much you are aiming to gain on that trade. It is written as a ratio. For example, 1 to 2 means you are risking, let's say, $10 to potentially make $20. 1 to 3 means you are risking $10 to make $30. And here is why this matters. You do not need to win every single trade to become a profitable trader. That's what most beginners get wrong. If you take 10 trades and you risk $10 each time, but you aim for $30 reward each time, even if you only win 3 trades out of those 10 trades, you are still profitable. Now think about that. You can lose 7 times, but because of risk to reward, you walk away as a winner. That's why this concept is so powerful. Why most traders fail. Now let's be honest. Why do most traders blow accounts? Because they completely, of course, it's because they completely ignore risk to reward. They chase profits without thinking about risk. They move their stop losses further and further because they don't want to be wrong. They over leverage because they think that because they think the one trade they are in will make them rich. I know this because I also did the same thing when I had started trading. When I had started, I had $100 account, and on that $100 account, I was risking $50 per trade. One loss, and I was basically finished. And guess what? I did lose that account. I blew that account because of that high risk. That's when I realized it doesn't matter how good your analysis is. If your risk to reward is broken, you are not going to last. Trading isn't about being right all the time. It's about surviving long enough for your edge to play out. And the only way you can survive is by respecting risk to reward. So, how do we calculate risk to reward in practice? Now, it is actually simple. You need to understand that risk to reward is equal to reward divided by risk. Let's say you buy EURUSD at 1.100. You put your stop loss at 20 pips below at 1.0980, right? Yes. That means that you are literally risking 20 pips. Now, let's say your target is 60 pips higher at 1.1060. That's a 60 pip reward, right? So, for you to get the risk to reward, you're going to divide 60 by 20 and you will get 3. That's a 1 to 3 trade. If you risk $100, your potential gain it's supposed to be $300, right? Now, that's how you set a trade that makes sense mathematically. The best part is that you don't need to be right all the time because over 10 trades, the math saves you. Even 4 wins at 1 to 3 can cover 6 losses and still leave you ahead. Now, let's talk about the psychology behind RR, which is the risk to reward. Why do most traders hate small stop losses? Because they want to give the market room to breathe, right? But in reality, what they are doing is hoping instead of planning. Why do traders hate waiting for 1 to 3 setups? Because they are greedy. They want the money now. They would rather grab a 1-to-1 quick and feel good, but long term, that doesn't build accounts. The truth is that risk to reward forces you to think in probabilities, not in emotions. Imagine this. You take 10 trades, each with a 1 to 3 risk to reward ratio, right? You lose 6, you win 4. That's 4 winners at 3R each, which is equal to 12R profit. Minus the 6 losers if you subtract minus 6R, you are still in plus 6R profit, right? You are still 6R in profit, right? That's how professionals think. They do not care about a single trade, they care about the next 100 trades. Because over time, risk to reward guarantees survival. So now let's go a bit deeper. Risk to reward isn't just about individual trades, no. It's about compounding your edge, right? So, say you are risking 1% of your account per trade on $1,000 account, that's $10, right? If you consistently take 1 to 3 trades, every win adds $30. Lose 6 trades, win 4 trades, you are up $60. That is a 6% gain without even having a high win rate. Now imagine applying this to over 50 trades. That's where compounding kicks in. This is also why prop firms put so much emphasis on risk. They don't care if you're a genius analyst, they care if you can manage risk because that's what keeps accounts live. You can also scale in with RL. For example, you take partial profits at a 1-to-1 to secure something, right? Then let the rest run to a 1-to-3. That way, even if it reverses, you have already locked in some profits. This is how institutional traders think. They don't gamble, they don't risk $100 to make $1,000 randomly. No. They stack asymmetric setups where the reward far outweighs the risk. Now let's look at the common mistakes to avoid. But of course, there are some mistakes people make with risk to reward. Now, mistake number 1 is chasing ridiculous ratios without logic. Now, aiming for a 1 to 10 setup on every trade, even when the market structure doesn't support it, that's fantasy, not trading. Now, mistake number 2 is that not adjusting stops when market structure changes. If you're risking 50 pips just because you don't want to get stopped out, that is not discipline, that is fear. And the third mistake is that traders thinking risk to reward guarantees profits. You still need a strategy with an edge. Risk to reward is just a framework that makes your edge profitable over time. So here is the bottom line. Risk to reward is the foundation of profitability. It's not just being about perfect, it's about stacking the odds in your favor. Even with a $20 account, if you master risk to reward, you can still trade like a pro. But without it, even a $20,000 account will vanish. So the next time you place a trade, ask yourself, is this risk worth the reward? If the answer is no, skip it. Protect capital first. Now, if this breakdown helped you, drop a comment saying RL so I know you are serious about risk management. Now smash the like button, subscribe, and in my next upload, I'll show you exactly how to use risk to reward on the real chart step by step. Thanks for watching, and remember, trade smart, not emotional.